Imagine you finally retired, excited for the freedom and the adventure ahead. Then, a few months in, you find out the federal government is effectively charging you hundreds of extra dollars every month based on a tax return you filed 2 years ago. There's a 5-letter acronym for this. It's called IRMAA. And while it gets bundled in with your Medicare cost, it functions a lot more like an income tax than a healthcare premium. What makes it especially frustrating is how easy it is to trigger by accident. Sometimes by going $1 over a threshold you didn't even know existed. What? In the next few minutes, I'm going to walk you through what IRMAA is, how it actually works, the moves you can make right now to stay out of its most expensive brackets, and a form most people don't know they can file to get that surcharge reconsidered when their income situation changes. IRMAA stands for Income Related Monthly Adjustment Amount. It's a surcharge added on top of your regular Medicare premiums once your income crosses certain thresholds. It applies to 2 parts of Medicare: Part B, which is your medical insurance, and Part D, which is your prescription drug coverage. In 2026, the surcharge kicks in once your modified adjusted gross income, which we call MAGI, goes above $109,000 if you're filing as an individual, or $218,000 if you're filing jointly with a spouse. Below those numbers, you pay the standard Medicare premium, and that's it. The moment you cross either of those thresholds, even by $1, the surcharge starts. And that's the first thing that catches people off guard. A lot of tax-related thresholds in the US work on what's called a phase-in. You go over by a little, you pay a little more. You go over by a lot, you pay a lot more. The penalty scales smoothly with how much you've gone over. IRMAA does not work that way. IRMAA works on what's called a cliff structure. The moment you cross the threshold, the full surcharge kicks in for that bracket. There's no gradual easing into it. $1 over means you owe the entire surcharge for that bracket for the entire year. And it gets sharper. There are multiple income tiers, each with a higher surcharge than the last. Cross one tier, you owe the full surcharge for that tier. Cross the next one, the surcharge jumps again. For a married couple in the top IRMAA bracket in 2026, the additional cost can run over $13,000 a year just in Medicare premiums. For a single filer in the top bracket, close to $7,000. That's an additional amount layered on top of your standard Part B and Part D cost. It can take what would be a manageable monthly Medicare bill and turn it into something much larger. What surprises most people about IRMAA is that the determination has nothing to do with what you're earning right now. Did you hear me? Your IRMAA surcharge for a given year is based on the income you reported on your tax return 2 years earlier. So 2026 Medicare premium is based on what you reported on your 2024 tax return. Your 2027 premium will be based on what you reported in 2025, and so on. And here's why that matters. The year you retire, your income usually drops sharply. Most people don't retire on 100% of their pre-retirement income. At this point, you've stopped earning a paycheck, you may not have started Social Security yet, and you might not be drawing from your retirement accounts. But Medicare doesn't see that drop yet. Medicare is still looking at your last working years, when your income was probably much higher. That's how income tax returns work. It's always a year lag. And that's why a lot of new retirees get hit with IRMAA in their first year or two on Medicare, even though they're no longer earning anywhere near the amount that triggered it. There's a process for asking Medicare to reconsider when your income situation changes, and I'll come back to that in a minute. First, let's talk about what actually counts towards that MAGI number. MAGI, or MAGI, is broader than just your salary. It includes wages, of course, but also includes interest, dividends, capital gains, withdrawals from traditional IRAs and 401ks, the taxable portion of your Social Security, pension income, and rental income. There's also something called tax-exempt interest, like the interest from municipal bonds, which gets added back in for IRMAA purposes, even though it's not normally taxed. What does not count towards MAGI, Roth IRA, Roth 401k withdrawals, health savings account withdrawals used for qualified medical expenses, and cash value build up inside certain permanent life insurance policies when accessed correctly. Do you get it? This is where, you might be starting to see some of where these planning opportunities are for you. If you can build up assets in those tax-free buckets before you go on Medicare, you can pull income from them in retirement without pushing up your MAGI. There's a form that most retirees have never heard of, and it could be worth thousands of dollars to some of you watching. It's called the SSA 44. The official name is the Medicare Income Related Monthly Adjustment Amount Life-Changing Event Form. What it lets you do is challenge your IRMAA determination if your income has dropped because of a specific qualifying life event. The qualifying events include marriage, divorce, the death of a spouse, work stoppage or reduction, employer pension changes, or the loss of income producing property. Now, for most of my clients, the relevant one is, of course, work stoppage or reduction. Again, depending on when you retire, but in other words, retirement. If you're newly retired and Medicare is basing your premium on your last working years of income, you can file SSA 44 with current income estimates and ask for the surcharge to be recalculated. This is one of those forms that belongs on every retirement checklist. If you're watching this and you're still a few years out from Medicare, the planning window for IRMAA is wider than most people realize. The goal is to give yourself flexibility in retirement so you can control how much of your annual income shows up on your tax return. One of the most common moves is building up balances in Roth IRAs and Roth 401ks during your working years. Withdrawals from these accounts in retirement don't count towards your modified adjusted gross income. Another approach is considering Roth conversions in the years between retirement and starting Social Security. Those are the lowest income years for most retirees, which makes them a strategic window for moving traditional retirement money into a Roth. And for those who are eligible, building up a health savings account is one of the most tax-efficient moves available. The tax advantages on an HSA are hard to beat, and withdrawals for qualified medical expenses in retirement come out completely tax-free. Each of these has trade-offs and needs to be looked at in the context of your full financial picture. None of them are a one-size-fits-all answer. If you think your retirement income is going to put you near one of the IRMAA brackets, doing this work in your 50s and early 60s is much easier than trying to fix it in your 70s. Aren't you glad you found me today? Now, let me walk you through a hypothetical example so this gets a little more concrete. Take a couple I'll call Miriam and Jack, both in their early 60s, both work in healthcare, both planning to retire in 4 years. Now, they've been good savers. Combined, they have just over $2 million in retirement accounts, with most of it sitting in traditional 401k and 403b plans, and only a small portion in Roth. Once both of them are claiming Social Security at age 67, their combined Social Security income alone is projected to be around $87,000 a year. Add in their required minimum distributions starting at age 73, plus interest and dividends from other accounts, and they're sitting right at or above $218,000, where that IRMAA cliff starts for joint filers. For a couple in their situation, one path worth exploring is a Roth conversion strategy in the years between when they stop working and when they start claiming Social Security. Those years are when their taxable income will be at its lowest, and every dollar they move out of the traditional and into the Roth is a dollar that wouldn't be counted towards MAGI later, when MAGI starts to matter for IRMAA. That's the kind of multi-year planning IRMAA rewards, and the kind of work that's much harder to do once you're already in the middle of the surcharge. All right, so before we close this one out, There's one thing I really want you to remember. I see clients all the time who get so focused on minimizing taxes and surcharges that they end up afraid to spend their money that they've worked their entire lives to save. If your retirement income is going to push you into one or two of the IRMAA tiers, treat it like any other planning challenge. Build it into the model. Look for opportunities to reduce the exposure where you can, and keep moving towards the retirement that you've been planning for. The whole reason you put this money away in the first place is so that you can enjoy this phase of your life. A Medicare surcharge shouldn't be the thing that holds you back from doing that. If you're approaching 65 or you're already on Medicare and you've been hit with a surcharge you didn't see coming, here's what I'd suggest. Pull out your most recent Medicare letter and your last tax return. Bring them with you to a no-cost, no-obligation conversation with us at the link below. We'll walk you through where your MAGI sits, where the next IRMAA tier kicks in, and what we can do to help you manage your exposure, whether you're still working, recently retired, or already in the middle of paying the surcharge. For some people, the right starting point is filing an SSA 4-4. For others, it's a longer-term Roth strategy. For most, it's some combination of the two and a few other pieces tailored to your situation. What I can tell you is that one extra hour of planning now can save you tens of thousands of dollars over the course of your retirement. And maybe that means connecting with us. Well, thanks for watching, and remember, peace of mind is built on purpose.
We want to help be your guide along the way about how to, access your money and the best places to get it with the ups and downs, and we want to help you to take advantage of those different market cycles. So if that's what you're looking for, please reach out to us.